everyone. This topic is about flexible budget and cost variances. Okay, after working through this topic, you will be able to first describe how unit standards are set and why standard costing systems are adapted. Then we will discuss what are the basic concepts underlying variance analysis and explain when variances should be investigated. The third objective is to understand static budgets, what the difference with flexible budget, and how we use budget to investigate variances. The fourth one, we will do a bit of calculations in terms of price variances and efficiency variances for direct cost categories, including direct material and direct labor. And the fifth objective, we will also calculate overhead cost variances, comprising variable and fixed overhead costs. So first, let's discuss about a standard cost system. Standard cost. So what do we mean by standard cost? A standard cost is the cost that managers expect to incur to produce goods or services under the operating plan assumption. So what are the assumptions? Key assumption can include the volume of production activities, production processes and efficiency, and also the prices and quality of inputs that you're going to use in the production process. So all the resources, including direct materials, direct labor, and all the overhead resources, in addition to the direct cost categories that you will be needed to manufacture your product or to provide services to your customers. If you look at typical cost standards for a manufacturing company, standard cost per unit of output, it will cover standard cost of direct material plus standard cost of direct labor plus standard cost of variable overhead plus standard cost of fixed overhead. So there are four components that makes up a standard cost for one unit of output. If you're gonna look at each cost component one by one, we can further classify it into two categories. So let's focus on the first one, which is standard cost of direct material. Standard cost of direct material, it has two main components, price and quantity. So you need to have information about standard price per unit of output and standard quantity per unit of output. The same as standard cost of direct labor. You need to include estimated or standard price per labor hour, and also what is the quantity or how long the staff will work to manufacture one unit of output. Now, if you look at the variable cost components, variable costs and fixed variable overhead costs and fixed overhead costs, it has first the allocation rate, okay, times the quantity of allocation base per unit of output. So in a nutshell, a standard can be thought as a budget for one unit of a product. Therefore, if we talk about standard, it can be a standard input. So if we say about standard input, so what is your expected quantity of input to manufacture one finished good? So for instance, you'll be using the assumption that, oh, my staff need to work for an hour, okay, to finish one finished good for my company. It can be also a standard price, so that is how much that the company expects to pay, okay, so for one unit of input. So for instance, well, the staff, this type of work, we will need to pay, let's say, $10 per direct labor hour. And it can also, standard can come as a standard cost, that is the cost to the company for one unit of output. So for instance, direct material cost of a completed unit. How our company develops standard costs? So there are two main techniques. So the first one is ideal standard. So which ideal it means like you assume that everything is ideal, everything is perfect. So no staff will put in sick leave, they all will work efficiently, so everything will be running smoothly. Okay, there is no machine breakdown, which is good in a way, but it can be also unrealistic assumption. Okay, if we think about this ideal standard setting, the impact of the ideal standard to employee motivation can be it motivates employees because you set a high level standard. It means like it can encourage them to achieve the maximum or high level of performance. Or sometimes it can also demotivate employees because you set the standard that is really hard to achieve or even impossible. Okay. Another technique is called currently attainable standard. So with this type, you incorporate some consideration that people are not always superhuman. Okay, so that you allow some errors. You allow that maybe there are machine breakdown in between. So with this one, it means you will also make allowance for some poor quality inputs. So this is like more attainable compared to the ideal standard. Therefore, if you use this type of technique, it means to set the standard for the next period, you need to reflect on the achievement for this period and then incorporate improvement for the next period. Why standard cost systems are adopted? So there are a few main reasons. So the first one is if you have a standard cost system, it will help the company to set product costing, which means, so let's say we assume that we are the company that just make a new product. So assume that this is January, so you finish the production by the end of the first week. If you have a standard cost system in place, you know roughly how much it costs you to manufacture one finish of product or one batch of production, which means you can start selling your product right away. If you don't have standard cost system in place, it means then you will need to wait until the end of the month to have all of the invoices and actual costs already incurred for the month, and then you start doing the calculation. So therefore, it is very useful for the company to help them to cost a product right away after completion. Another benefit is also to help them to enhance planning of future costs, because with standard costs we can evaluate the performance and investigate and also think about what improvement that can be made. And also it will be helpful to monitor and motivate employee performance if you set the standard and if you link the standard achievement with reward system for the companies managers and also employees. For most businesses, cost control means the difference between success and failure. So how do we use standard to control costs? Standard costing is a part of the control system. So first you will set the standard. This is before you start the production. So let's say you set the standard in December to be used for January from January 2020 to December 2020. So in December 2019, you will calculate the standard of cost, amounts of material, labor, and overhead. Then once you're going through the production in 2020, you will have data about the actual cost that you actually incurred for the production. Once you compare these two and then you can look at the difference, this is what we call cost variance. So what is the impact of cost variance on your operating income? Once you finish your calculation, investigating the difference or the variances between the budget or standard with the actual cost, then you will also need to think about the impact of variances. Can be classified as unfavorable or favorable. If we say unfavorable variance for revenue items, unfavorable means the actual revenue are less than budgeted revenue. But if it is regarding cost items, so unfavorable cost means the actual cost that you spend actually more than the budgeted cost. Okay. And also, on the other hand, if it is favorable variance, it means the actual revenue that you receive is actually more than you budgeted. So your wallet is happy. However, if we talk about cost, favorable cost variance, it means you paid less than you expected to pay. So let's discuss about flexible budget and variance analysis. Variance analysis, it is used to improve future operating plans. So actual the operation compare with the budgeted or forecast of the operating plans. So you compare the plans and the actual really. Once you highlight the difference, this is what we call variance. Once you calculate the variance, remember you need then to review which variance that needs further investigation. Not all variances has to be investigated. Then the next step will be you need to play a detective here. You need to identify possible reasons for these variances. Then you need to draw conclusion and take action how you can deal with these variances. So in a summary, if we want to do variance analysis, we will need to look at three different sources. So the first one is static or master budget. So this is what you discussed last week. Master budget consists of budgeted or standard revenue and cost times budgeted volumes. Once you finish the production, let's say you have the actual volume of production, then you can create flexible budget. How do you create flexible budget? So you use the actual volume times the budgeted revenue and costs. If we talk about the actuals can be calculated from the actual revenue and costs times the actual volume. So flexible budget. What is flexible budget? Flexible budget is usually prepared at the end of the periods after managers know what is the actual output of the production. Okay, and how do you prepare flexible budget? So you basically just recalculate all the items for budget, assuming that now you will do the calculation using the actual output of production. Why do we need to do this? Why do we have to bother using calculating flexible budget? So the main advantage of flexible budget is to allow you to compare actual result and the budgeted result for the same activity level. So in summary, here are the 3 steps for you to develop flexible budget. First, you need the data regarding the actual quantity of output. Then, you need to calculate the flexible budget for revenue. If we want to look at the revenue, so you need to use the budgeted selling price times the actual quantity. If we want to calculate flexible budget for cost, you need to use the actual quantity times the budgeted per unit variable cost plus budgeted fixed cost. Remember, budgeted fixed cost is still the same as the static or master budget. In terms of variance analysis, therefore, we can calculate four different types of variances here. The first one is budget variance. So budget variance is a result when you compare static or master budget with the actual result. But if we want to focus on the volume variance, so you compare static or master budget with flexible budget. If we want to look at the price or efficiency budget, you compare flexible budget with actual result. So therefore, in summary, if we want to look at the budget variance, it consists of volume variance plus price or efficiency variance. So if you recall, this is kind of similar with the first exhibit or the first diagram that we have a look, that every cost consists of two main components, the volume and the price component. Therefore, the same with the variance, you have volume variance and price or efficiency variance. So to give us a clear idea in terms of this topic, so let's have a look at the activity. The activity here is first one, exercise 10.22. Then we're going to go through 10.29. Remember, I will always encourage you to spend your time for study to go through the exercise 10.28. That's for self-study.